Hello everyone, this is Marshall Gidler, Head of Investment Research here at FXPRIMUS, bringing you a special report on the Bank of England Monetary Policy Committee meeting. The Bank of England's MPC surprised the market by taking more active measures to support the economy than people had expected. The pound fell sharply in reaction. Now, in my view, those measures are likely to weaken the pound further over coming months. Here's what they did. 1. They cut their bank rate, the overnight rate at which the Bank of England lends to banks, by 25 basis points to a new record low of 25 basis points. This was the first change in rate since 2009. At the same time, they said that a majority of MPC members expect further cuts this year to what they said was the lower bound of rates, that is, close to but a little above zero. So, while they effectively said they wouldn't go to negative rates, they did say they'd go to, let's say 10 basis points or so, which was all the easing that the market had priced in already. Secondly, they announced a term funding scheme. This isn't so significant for the FX market. It's just a way to ensure that banks don't lose money when interest rates fall, because they can't lower their deposit rates as much as their lending rates fall, so their interest margin gets squeezed. The bank will then therefore lend them some money at a special cheap rate. The ECB basically does the same thing. 3, they also dusted off their quantitative easing program and said they'd buy £60 billion worth of gilts, which was a surprise to the market by and large. And they also said they'd buy $10 billion of corporate bonds, another surprise. So this was more than people expected. And significantly, after doing all this, they stated outright that there was room for them to do more in all these measures. And as we've seen with the ECB, the Bank of Japan, the Swiss National Bank, etc., once they get going, there doesn't seem to be any stopping them. That was one big reason why the pound fell. The other reason for the pound's weakness is the change in their forecasts. They're now forecasting much weaker growth next year and the year after. As a result, they're also forecasting much lower interest rates, which makes sense. But they're forecasting higher inflation. That means lower real interest rates. Now, this is probably a deliberate policy to encourage borrowing and spending. However, lower real interest rates will make it harder for Britain to attract foreign capital to fund its enormous trade deficit. They also forecast that business investment will plunge. That means less foreign direct investment, I assume. On the other hand, they did say that exports are likely to grow faster and imports not so much because of weaker sterling. That may improve the trade balance somewhat. Overall, though, I think this will just worsen the main problem for the pound. The problem is that the country has a current account deficit of some 6% of GDP. Enormous. That's the graph on the left. Now, that may improve a bit under their forecast for exports and imports. But on the other hand, they're financing that enormous deficit by inflows of capital into direct investment, bonds, and equities. But with business investment forecast to plunge, growth slowing, and real interest rates falling, it seems to me that there won't be as much reason for people to invest in Britain. The trade balance may improve a bit, but I'd expect the capital inflows to fall a lot more. The result? A weaker pound, in my view. This is Marshall Gidler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.